Good day and welcome to the taxation of deceased persons and their estates. Part of your notes for this will include a liquidation and distribution account. It's not that relevant to the first part of the estate. In the first part of this seminar, I'm going to deal mainly with the normal income tax consequences of death. In the second part, we're going to deal with the estate duty consequences. But for both of that, it would be useful to refer back to the L&D account. So I want to tie that in and make it practical, what we're discussing there. So we're starting with the taxes payable on or after death. And as is commonly said by Benjamin Franklin, nothing can be said to be certain except death and taxes, and of course at death there's also tax. And that's, I think, a surprise for a number of people, that when you die you also have to pay taxes. So there's an exit tax when you leave the world. I always say it's relatively cheap to come into the world for yourself from a tax point of view, but when you leave, as you'll see, it's relatively expensive to do so. The focus of the seminar is on deaths that where the person died after the 1st of March 2016. So this is in respect of a person that dies on or after 1 March 2016. So I chose this death certificate. It gives a 2016 date on that. It's substantially different, and from a normal tax point of view, if you died before the 1st of March 2016, so 28 February 2016. So in fact that is 29. Let's just make two definitions that I'm going to, throughout the course of this webinar, use extensively. The Act refers to a deceased person, that is a person that died after the 1st of March 2016, and then the estate of a deceased person. And it's worthwhile, I'm going to repeat this again, worthwhile saying that again. Now, important to stress that the estate of the deceased person is a separate taxpayer to a deceased person. So we have the deceased word in both of them, but we must not confuse it. And I actually find that most of the people that have questions about it confuse the two. So there's one person, it's a deceased person, and the other, from a tax point of view, is the estate of the deceased person. Right, okay. What happens after you die? Of course, from a tax point of view, we're not dealing with the other issues there. Your life as a taxpayer actually comes to an end. I put life in inverted commas because this is a taxpayer. When you are born, you start earning income, you register as a taxpayer, and that life as a taxpayer comes to an end at the time of death. Important, there's some administration. I don't want to deal with administration this much in this seminar. The executor must notify SARS of the death, and the death notice is what is done, the way that this is communicated, one of the supporting documents. So they say you visit the nearest SARS branch, but I don't advise that. You can send an email to the contact center closer to the Master of the High Court where the estate is being administered, and SARS will then start the process of registering this new taxpayer from that. I'll explain a little bit more about that. So when I report an estate, use this contact north, contact central, contact east, or contact south at sars.gov.za emails and alert them to that. And I'll stress the importance of doing this throughout, well, when we get to more detail of what actually, how the taxes are how this is affecting your tax liability to SARS. So very important, there's an action from the executor. It's necessary to alert SARS to the death of the person. Now, there's a timing difference here because it takes a while to get, in many estates, to get the executor appointed. So often the reporting is done by the tax practitioner or by family members. And that's what we call coding the estate. We'll talk about that in more detail. So the estate is coded. And the importance of this is that SARS recognizes on the system that this person's life as a taxpayer has come to an end. So this notification tells SARS that the deceased, let's go back to that, so the two persons, that the deceased person stopped being a taxpayer and that there's a new taxpayer, the estate of the deceased person. Okay, so that's the coding of that. How does that affect the obligation of the taxpayer to submit returns to SARS? If we look at the Income Tax Act, we're dealing with income taxes first. The return for normal tax, so that's your ITR 12, to be made by any person in respect of a year assessment, shall be a return in the case of a person other than a company for the whole period of 12 months ending upon the last day of February. So companies can have year ends other than that. But then in a proviso to section 66, 13a, it says, provided where a person dies, a return shall be made for the period commencing on the first day of the period and ending on the date of death. So what we have is, if we look at this, your period starts on the 1st of March and end on the date of death in the year of your death. That's very important, comes from the Income Tax Act. Now, another important principle is that because the taxpayer is no longer alive to put in the return, so to speak, you have to have a representative taxpayer, somebody that represents the taxpayer. And this is a natural person who must reside in the Republic. We often find now that people are appointing somebody, family members, as executors, and then we find that the family member has immigrated or is now permanently residing in Australia, New Zealand, wherever it is. You need a representative taxpayer who resides in the Republic, so has an address in South Africa, and that person can be appointed as a representative taxpayer. If we look at section 1.1, it defines a representative taxpayer in respect of income received by or accrued to any deceased person during his or her lifetime, and the income received or accrued to the estate of any deceased person that is the executor of the estate of such deceased person. Again, you see that deceased person and the estate of the deceased person. So the executor or the representative taxpayer, the executor will be appointed as the representative taxpayer. And the representative taxpayer is responsible to declare the income in respect of the deceased up till the date of death, lifetime, and then in respect of the estate of the deceased person to SARS. Now, if we look at the Tax Administration Act, it says every person who becomes a representative taxpayer, so every executor, must notify SARS within 21 business days of becoming a representative taxpayer. And you become a representative taxpayer, or you become an executor, let's get the order right, when you get the letters from the master that you're appointed as executor, and then you inform SARS that I will take on the position as representative taxpayer. You don't really have an option here. The executor is the representative taxpayer. The law is quite clear about that. So you must take that appointment when you act as an executor. The question of provisional taxes, for those of you that have been dealing with the states, is that this was a nightmare. So based on the current legislation, and current is as of October 2019, when we're doing with the seminar, it excludes only a deceased estate, which was a new development that came in about 2 years ago. It doesn't exclude the deceased person in the year of death. So this is, and we've been lobbying for this for a while, that really should be fixed. And SARS acknowledges now, and this is only the draft. We have seen some comment on that, but the bill has not been tabled in Parliament yet, so we don't have a final memorandum of the objects of the Tax Administration Laws Amendment Bill. And SARS acknowledges that there's no exemption from the payment of provisional tax by a natural person in respect of the period ending on the date of death. And they say which results. This is the SARS practice at the moment in the imposition of an underestimation penalty. I mean, this is absurd. You're expecting the deceased to a couple of minutes before death, on the day before death, to submit an RP6. If you don't, they hit you with the underestimation penalty. And then it's really welcomed now that they are looking at changing that. So they say a deceased person may be subject to the underestimation penalty on assessment of no estimate was submitted by the executor within the 4-month period. This is not really true. Yes, the Act allows us to, after 4 months after the end of your second period, to submit a return. And it deems you, if you haven't submitted that return within 4 months after that period, you've submitted a null return. So that's an automatic estimate. But there is, in the first instance, a failure to submit an estimate on date of death. And that is what the problem is.